Hi everyone, let's talk about what's happened in financial news this week. So it seems like the main story that's been playing out in the US this week has been the story that has been the story for much of this year, which is the story around growth. And some very key data points came out throughout the week, which we can review today and talk about today. But really, the main focus of the markets at the moment seems to be to gauge how much the US economy is growing still, how strong is that growth, and whether the US economy is actually showing any signs of slowing down. Because ultimately, and this is what all traders are kind of honing in on, is we're looking for signs that the US economy is slowing down, because if the US economy is slowing down, then that gives the signal to the Fed to start lowering interest rates. And for those of you who might not follow these things that closely, lowering interest rates and lower interest rates in general are seen as a very positive thing for equities. Lower interest rates and lower yields on other asset classes like bonds, treasuries and corporate bonds, etc., just make equities more attractive by comparison. So if you're an investor picking between different asset classes, when interest rates and when the return on fixed income, for example, starts going down, well, in comparison, it just makes equities more attractive, and it helps justify the risk that you're taking on by investing in equities a little bit more. So that's why everyone is just honing in and so focused on interest rates, because the lower they go, the more attractive equities will become. And this week has definitely been a bit of a mixed bag in terms of the data points that have come out, in terms of the US labor market, and we can review some of those today to really try and understand what the picture is. So at the start of the week, the first one of these data points that came out was provided by the Institute for Supply Management, that releases essentially a manufacturing output data point, measuring whether the manufacturing in the country is either in expansion or contraction mode. So that data point indicates that the economy in terms of manufacturing output is slowly beginning to shrink. Now, that in itself is a signal of a slowing economy and would be something that is interpreted as a slowdown in the US economy by traders. And any slowdown, weirdly at the moment, any slowdown in the economy is almost seen as a positive thing by traders, because it signals this potential reduction in interest rates. But I feel like this is the thing with financial markets and investing, is it really is down to how people interpret some of this data. Because on the one side, you could say, well, okay, lower manufacturing output means that we're getting an economy that is slowing down, which might be good because that will also slow down inflation, which means that interest rates can start falling down, which is great for equities. But at the same time, you don't want the economy to slow down too much, and you don't want to lose too much growth, because that's also really bad for the equity market, because ultimately profits in equities are driven by the spending that is being done in the economy. Large corporations, or any corporation really, cannot continuously make profits if people don't spend more and more money. So in an economy that is slowing down might be good because it will bring down inflation, but you don't want your economy to slow down too much either. So it's a very delicate kind of balance between the two, and this is what everyone is wanting to see play out here. We want to see a reduction in inflation and interest rates going down, but at the same time, we don't want to sacrifice the growth too much. So everyone's happy to see a little bit of a slowdown in the economy, just enough to trigger this reduction in inflation and interest rates, but nobody wants to see too much of a reduction in growth, because that would, in a way, that would be even worse for equities than anything else. You want the economy to be growing at a moderate pace, whilst interest rates are going down and the inflation is going down. That, if you've heard the term, is the soft landing that everyone has been talking about. It's also the Goldilocks scenario, as it's being called, and it's also, you know, just like a very rosy type of situation. You want your economy to grow, but you don't want to have any inflation. You want people to increase their spending, but you don't want to see any inflation. You want interest rates to be coming down, which will help people spend more, but you don't want to see any inflation. It's a bit of a perfect kind of scenario where everything aligns very nicely. But so far, there's no reason to believe that scenario isn't going to play out, because so far this is what we've seen this year. So first data point, manufacturing output, we are in contraction mode, so that is an indicator of a slowing economy. And there's some other sort of key things to take note of, I suppose, in the US, in terms of where the economy is at in terms of growth. So growth in the economy is driven by spending. People need to spend money, and that spending that comes from the government, it comes from households, obviously. That spending is going on services and goods, and ultimately translates into profits for corporations. And those profits are what, in the long run, will drive the share price of any company. So you cannot, in the long term, be a company that consistently doesn't make any money ever, and your share price continues to rise and rise and rise. So profitable companies will see their share prices rise. Terrible companies and non-profitable companies will see their share prices fall. So you need spending in the economy if you want the stock market to keep going up and share prices to increase. So spending in the economy can really only come from a few different places. So either people are going to be spending their own money, so they need to be using up either their savings, or they need to see their incomes increase, or they will need to finance that spending through borrowing and credit. And just reading through some financial articles out there, it seems that currently, for example, the savings rate in the US is at a 16-month low, and it seems like households have mostly just used up a lot of their savings already. So there isn't too much of a buffer in terms of savings that US households can rely on in order to continuously spend in the economy. We also see that a lot of consumers are maxing out their credit cards already. We're seeing delinquency rates, so these are people that default on their credit card payments, are actually on the rise, which is again an indication that there was some spending being done using up that credit portion. So people were borrowing money in order to spend, but now we're seeing more and more people default on those loans, meaning that they won't be able to continue renewing them and continue spending in this way. So you've got savings that is drying up as a source of spending, you've got credit that is drying up as a source of spending, and the third piece, which is people's incomes in real terms, so that is adjusted for inflation. We know that in real terms, incomes aren't necessarily growing by all that much, and we'll get to that point in a second. But the third source of spending in the economy that can continuously drive spending further and further is an increase in people's incomes in real terms, again, so that is adjusted for inflation. And we're seeing that those types of increases are very, very moderate in the economy at the minute. So it's not necessarily also a very growing source of available money for people to spend. So those were that was some of the information that was available at the beginning of the week. So again, maybe to summarize, so there was an important release in terms of manufacturing input that painted a picture of perhaps a slowing economy in the US. And me reading some analysis out there, you could also say that there are various sources of spending in the US economy that are slowly beginning to dry up. and those are mainly the savings that people have and the credit that is available to them. Let's also not forget that at the moment interest rates they're like a 2-decade high, and that is also making borrowing quite expensive for people. So credit is also not the most easily accessible source of financing and spending in the economy. So those things put together are showing painting a picture of a US economy that is slowing down. And then at the end of the week, so on Friday, is probably the most important key data point that came out this week in terms of the US labor market, and probably the most consequential data point, the one that will be talked about the most, interpreted the most, and probably the one that is able to sway the decision that the Fed is going to be making next week on whether to cut rates or keep them where they are, is the jobs report that came out on Friday. And that jobs report essentially measures and provides you two key metrics. One of them is what you call the non-farm payrolls in the US, and the second one gives you a measure of what the unemployment rate is looking like. So both these data points are collected through surveys. One of them, so the first one is more of an institutional survey that is done with corporations, essentially to understand what their payrolls look like, literally like how many new people they've taken on their payroll in the last month. And the second one is more like a household survey, just trying to gauge, speaking to households, what the unemployment rate is like in the economy, right? So that second data point is always considered of having a larger margin of error, maybe a little bit less precise. But ultimately, the interesting thing about this report that came out now is that it really paints a mixed picture, because on the one side you have the non-farm payrolls, which really are the private sector payrolls, if you will, because they don't include government jobs and NGO jobs and things like that. So those payrolls actually increased by a lot more than what people expected them to. So there was a big surprise on that front. And that in itself is an indication of a growing economy. If more and more businesses are taking on and paying more and more people on their payroll, well, then that can only really be an indication of an economy that is still growing, an economy that isn't slowing down. On the other side, the unemployment rate also increased slightly. So you have two data points that are telling you two different stories here. One of them is telling you, well, the economy is still growing, there's more and more people on the payroll, and the other one is telling you, well, actually, there's more and more people that are looking for work that cannot necessarily find work. And that in itself, and those two things, aren't necessarily mutually exclusive though, because they do measure slightly different things. For example, payrolls is just payroll. So one person that has two jobs, for example, can appear twice in that payroll data. So you can have that data increase and also have the number of people that are looking for work or willing to find work and cannot find work or haven't found work yet. You can also have that number increase, right? So they do measure slightly different things, but ultimately they are painting two separate stories, which isn't, once again, completely unusual, because they do measure slightly different things in the economy. So there are natural divergences that happen between the two. But definitely, if you look at the non-farm payroll data, that is an indication of an economy, a fairly solid indication that the economy is still growing, and most importantly, that number came in much, much higher than what people expected. So for us, people sitting at home, and I'm definitely just, someone that has a lot of interest in this stuff, someone that reads a lot of financial news, but at the end of the day, I'm just someone that's sitting at home trying to make sense of all this and trying to understand, okay, what am I doing with my portfolio? Like what am I supposed to take away from all this? I mean, there's all these mixed signals in the economy at the moment. There's one side that's telling me the US economy is slowing down, the other side's telling me that the US economy isn't slowing down. So what am I to make of all this? Ultimately, is the stock market going to keep going up? Is it going to crash? Like what? For me, the way to interpret this kind of mixed information and these mixed signals from the economy is that one thing that I feel pretty sure of looking at these numbers now is that the US economy definitely isn't in a place where it's hitting the brakes hard, right? Because if it was hitting the brakes really hard, then there would probably be a more uniform story across all these different data points. So you would see the payrolls decrease or be lower than expected, and kind of all these data points, you probably expect them to all tell you the same story if the US economy was really hitting the brakes hard. So that's looking at perhaps more of the extreme case, like the hard landing. So the interest rates have been at a 2-decade high for the past year or 2 years or whatever, and now we've held them there for too long. Spending in the economy is totally drying up, and all the data points are now indicating for sure that the US economy is massively hitting the brakes, which in itself would not be a good thing, right? This is coming back to what we were talking about at the beginning of this video. So investors want to see the US economy slow down enough so that inflation gets back to where we're comfortable with it, and then that would be enough for the Fed to start lowering rates, which in itself would also be positive for equities. So you would have an economy that's still growing, but growing at a moderate pace, interest rates that are coming down, and both these two things together, Goldilocks scenario, soft landing, fantastic. We managed to kill inflation without killing the economy. The stock market can continue roaring on. I feel like that scenario, given the data that we have, it's still kind of playing out, because the US economy is not hitting the brakes hard. Inflation has been a little sticky this year. We've reached a level of inflation where it doesn't seem to be really going in either direction really this year. I mean, it was going down, then it started edging up slightly again, then it started edging down slightly again. So we have a sticky kind of inflation that's remaining there. But one thing that is for sure is that the US economy isn't crashing either. So overall, and it looks like the markets are pretty much interpreting all of this data in this way, because this week has been a good week for the S&P 500. I mean, on Wednesday, the S&P hit basically a record high and almost did again on Friday. So in terms of how investors are interpreting this data at the moment, is that the rally, the equity rally is still on. The US economy isn't showing worrying signs of slowing down, but it's showing some signs of slowing down, which again is what everybody wants to see. They want to see the US economy slow down, but only slow down a little bit. What that means for the Fed and when the Fed is going to cut rates, I mean, look, that's just, we're going to have to wait and see. Those kind of expectations keep getting pushed back and back and back. We were supposed to have some cuts in the interest rates already this year. We haven't had them yet, but that hasn't transpired into anything negative for equities. People are still buying stocks. People still believe in the fact that this soft landing scenario is going to play out. So we're going to have to wait and see what the Fed says next week. I mean, everybody expects them to keep rates where they are basically, but it will be important to analyze the type of messaging that they're coming out with, and to see what that means for the lonely investors sitting at home like you and I. And ultimately, I'm a long-term investor, right? So I'm not someone that trades the S&P 500 in and out every single week. I'm just someone that buys it and holds it really for the most part. But I still feel like it's really important to get comfortable with reading the economy in this way, because the stock market sometimes does really crash. And if you could get yourself to a place where you're buying and holding, but strategically allocating at times where you feel like, okay, we're getting a lot of worrying signals from everywhere. The stock market is going to be tanking quite a bit over the next year or so. If you can get yourself in a place where you can strategically reallocate your positions in those types of moments and avoid the biggest drawdowns and the biggest crashes, there's a lot of good profit to be made this way, and definitely you can save. Well, I mean, I can save. We can save ourselves a lot of pain. So yeah, please let me know in the comments below. I mean, this has to be a conversation. This has to be a forum for people to just exchange ideas and how they're reading all these things. And us normal retail investors, we can only help each other in this, because we don't have all the tools that the big investors have, and we just don't have the resources and the research resources to compete on that level. So we must have communities, and we must discuss these things between each other. So definitely, if you feel like I'm totally missing the point of the data here, then let me know. If you feel like there's other really important data points that have to be discussed, then definitely let me know. If you feel like there's something else that needs reviewing, any type of financial news that's really key that I'm not talking about here, then definitely let me know in the comments below. And yeah, let's just start a conversation and keep it going. And yeah, I'll see you on the next one.